I think they are very cognizant of it, but if you look at some of the base effects from carrying over from last year, from where the oil price moved and how it's stabilised, I think what you'll see is some of those embedded inflation concerns are going to actually feed out of the economy. So I think concerns about pernicious inflation are sort of overestimated at this point.
So where's the justification for this wholesale shift in the market to believe that rates are going higher from here? Because it does feel like we've psychologically turned a corner, but the data doesn't really stand up the interest rate hikes, does it?
Yeah, I think there's two things here. I mean, from our perspective, we think that this sort of rate cycle is going to be relatively benign. The inflation story, there isn't a sort of a pernicious inflation story in the backdrop. You can't ignore the fact that some of the investor expectations have picked up for inflation. So if you look at the break-even market, you look at some of the term structures on the forward interest rates are suggesting higher rates on the basis of inflation, but we think that will work itself out of the economy. So we expect less rate hikes, a very benign rate hiking cycle, and inflation to continue to be relatively benign, and that will be reflected in monetary policy.
Patrick, let me bring you in here. The policymakers usually point to temporary factors when they talk about oil prices. How long can they get away with this? It's not really temporary, it's everlasting.
Oil prices, so we're short oil. I don't even expect oil to fall much from here, but it's a very high roll cost with oil. So if you're shorting oil, actually, if oil prices stay flat, an oil index is going to fall 10% because of the roll cost. So that's our view on oil. If you do have a moderation in oil prices stay where they are. It goes away from a disinflationary backdrop to something that's neutral. And I think that's what we're going to have for the coming year. So we've seen falling oil prices create disinflationary forces. I think in the coming year, you're not going to have that anymore. We're not of the view that inflation is a big risk right now, but if you're a policymaker, do you need interest rates below the rates of inflation? And that's still very stimulative. And I think that's how the central bank governors are thinking right now. Do we need interest rates at 1%? Inflation's not 2%, but core inflation is just a bit under 2%. Headline inflation is just very slightly under 2%. If you're creating 150,000 jobs every month, which is the track the U.S. economy is on, you're going to have unemployment below 4%. There will come a time when that's going to force higher wages. So I don't know when it'll be, but if you look state by state, Colorado's got unemployment down around 2%. You are seeing significant wage inflation pressures there. So there will come a time when unemployment does create higher wages, and that'll create some inflation. Okay.